Everyone, how you doing today? I hope you are enjoying your weekend. It's Sunday, which means I got to do my goals for you. Again, goals are important. Shared goals are important. Tracking your shared goals and kind of sharing the results, right? It's kind of where the magic happens. So after this video, I will be putting together the details of my goals and also really start thinking about what I'm going to be doing the next 13 weeks. I've decided to break my goals up into 13-week chunks so they can feel more real and tangible, and we could really see activity inside of a 7-day window. So that's going to be a lot of fun. Today, actually, I did a bunch of reading, and then I stumbled across this article and threw everything else away. And we're going to talk about 19 bear market indicators that Bank of America found and shared with their clients. This research went back to the 1960s. The key to this research, they're saying, is if 80% of these 19 indicators, so what would that be? That'd be like right around 15 of them trip, then a bear market is very likely. They did say in the article that today we're at about 62%, so not close to their 80% mark. They're not calling a bear market, but I thought it was interesting. As I went through all 19, I think there was 5 or 6 I'd never heard of before. And I look at this stuff every day, so it's interesting, all these different little indicators that people think are the key to understanding a future decision, right? There is no crystal ball, there are no things, but hey, maybe there are 19 crystal balls that you look at and there's something in the future. So let's go through them. I'm going to go through them in the order that the article did and talk about them. If I know them, I'll share my thoughts on them. If I don't, I'll just say I don't know them and we'll move forward. So the first indicator of a bear market coming is actually the Fed raises rates. If you want to go back and just look at 2018, I think it was, where the Fed raised rates 3 times before having to cut in 19, you could certainly see that the market was grinding to a halt, or at least grinding to a slowdown, where a recession could have been likely should they not have reversed course. So that is certainly an indicator, probably one we've all watched and thought of. But that's number one. Number two is one that I have felt on occasion. It's not talked about a lot, and that is tightening credit conditions. Not a lot of people, individuals, go out into the credit market as often as I do. Right, every time you're going to buy or refi or whatever, you can really start to feel tightening or loosening credit conditions. I would say in today's market, we are on the loosening side. And I suspect with rates falling, right, on Friday we talked about the 30-year Treasury dipping below 1.9, which as I sit here on Sunday, I still can't believe. Who's going to lock up money for 1.89% for 30 years? My gosh, that's scary. So again, number 2 is tightening credit conditions. Number 3 and 4 I thought were interesting. Basically, number 3 is the market, right? The stock market has returned greater than 11% in the last 12 months. I guess what it's saying here is you get a bear market after a bull market, right? You sort of get that pop, that last pop in the bull market, and the bear market ensues. Okay, if that's what the numbers say. Number 4 was actually even more interesting. It was a 30% return in the market in the last 24 months. That one I kind of get, right? The 11% is kind of like, that's just a good year, right? 11% a year, that's not great, that's good. But maybe a 30% return in 24 months feels like valuations are being stretched. So I certainly get number 4, right? That 30% makes sense. Number 5 is low quality stocks outperform high quality stocks. The article doesn't really talk about what they mean by quality, which I thought was a missing element. I'm going to assume that means companies with no earnings are outperforming companies with earnings. But again, that is a guess. It could be their bond ratings, right? People with worse ratings outperforming people with good ratings. But again, it doesn't talk about it. But again, you could see why a bull market is being stretched is when the low quality names are getting bid up over high quality names. So kind of get that. This one makes a ton of sense to me. Number 6 is momentum stocks outperform for the last 6 and 12 months. Man, talk about the 2000s, right? That was all about momentum, and I still have the scars to prove it and probably talk about it too often. So again, it makes total sense. To me, I think Tesla in that SpaceX, man, talk about some momentum stocks getting bid up by people that aren't paying attention. So, whew. In addition to momentum stocks, growth stocks, cool, nice. Where was I? Growth stocks outperform in the last 6 to 12 months, just like I guess it's growth versus value, right? They're saying that growth is being rewarded over value, is what I think they're saying. So that's interesting. Number 8 was I didn't expect number 8. Number 8 was sometime in the last 12 months there was a 5% pullback, right? There's kind of a you're up, you're down, and then kind of buy the dips, sell the rips is I think what they're talking about there. So again, a 5% pullback in the last year is kind of a sign that a bear market. And I don't think I talked about what a bear market is, at least in this article. That means a 20% pullback, right? So significant. Number 9 was low PE or price to earnings stocks underperform, which is kind of interesting, right? Low PEs, you would think those are the value plays, right? They're kind of splitting hairs here on these, but again, something we can all watch for, right? When the high PE companies are getting bid up and chased, either their momentum or growth stocks, and it could be a problem. Consumer confidence has not hit 100 within the last 24 months. Frankly, consumers is one of the reasons I do what I do. I'm trying to track and try to understand what they're doing, what they're feeling, greedy versus excited or afraid. And that makes sense to me, right? Because we're a consumer-based economy, so that's interesting. Number 11 is the confidence board expects stocks to go higher. This is kind of right? Everybody is on one side of the trade, kind of sets us up for the fall. But again, it's one of those things. This one was interesting. Number 12, earning beats are not rewarded. I wasn't really sure what that meant, rewarded, but I thought it was an interesting measure, right? Because you should, historically speaking, a beat and raise, as they call it in the market, normally would mean a nice stock pop. So when we have companies doing beat and raise and maybe their stock goes down, I guess that makes sense. I had never thought about that one, never heard of that as an indicator of a bear market. So that was new data I added to my bag of tricks. Sell side indicators have optimism. I don't know what that meant, but I'm guessing everybody thinks the market is going up, and everybody's trading on one side. Number 14 is absolutely something I've tracked and think about all the time, and that's levels of cash. All right, what are quote unquote the rich, the traders? What are they doing? Are they normally in 5 or 10% cash and suddenly they're in 20? What are they doing? Because again, being in cash means you're not in a trade. So again, even if you're getting very low interest, you feel something is coming, so you go to cash, right? So that makes total sense. Number 15 is probably the one that is talked about the most. It gets blasted all over CNBC and CNN and Fortune and all these other magazines. And that is, of course, the inverted yield curve. Who hasn't heard about that in the last 24 months? Basically, where borrowing short is more expensive than borrowing long, right? It's not natural. You should be rewarded more for borrowing long. So when the market is really afraid, the inverted yield curve is usually a sign of something to come. Of note, we had it, I think it was last year or maybe late the year before. Thus far, no recession coming, and I don't see one coming this year. So that was a false positive for sure. Number 16, almost done. Changing long-term growth rates. This, I suspect we're going to see this one, right? I think this thing we're all dealing with in the world and China and the like is, I think it's going to hurt worldwide growth, at least in the first quarter, probably the first half. I don't think it's going to have a huge impact on the U.S. specific, but when you think about growth rates, we got to remember we are one part of a large machine. We might be the biggest part, sure, but there are lots of other parts, and I think those other parts are going to be slowing down. So we should watch out for that. Um, I had never heard of number, what is this, 17? Never heard of it. Let me know if you've heard of it. It's called the Rule of 20. Never heard of this. It's the average PE added to CPI, and that's above 20. I never heard of the Rule of 20. Again, PE added to CPI above 20. I don't even know what that means. I'm guessing that means the average price to earnings ratio, which is probably in the teens, plus the consumer price index. I don't even know really what they're saying. That's inflation plus high PEs. I don't know. I'm gonna have to look that one up because again, there was a couple in here that I never heard of, and that's one of them. Uh, Number 18, volatility spikes to over 20 within the last 3 months. It makes total sense. It's kind of the market's trying to figure itself out, right? And that means that volatility is going to increase. And the last one is there has been an increase in negative earnings revisions, which is, to me, that's the first thing that starts, right? Because companies are always talking about kind of giving you a report card on the last 90 days, and they're giving you the forecast for the future. And if they're having negative earnings revisions, instead of making $1.03, we're going to make 97 cents. That's an early indicator, and I expect some negative earnings announcements here in the first quarter. So we will see. I don't think a bear market is around the corner, but I think it is interesting to understand what could be. And I thought that was an interesting article to go through. I will try to find the link again and put it in the show notes. I'll have to go back and find it. I looked at lots of articles today, so let's hope I can find it. And in the end, I want to thank you for watching. I'm going to go ahead and do my goals video, and today's going to be a fun day. All right, take care. Bye.